Welcome to the video. Today we will break down why, during major financing like a mortgage or a home loan assumption, you should prioritize total credit profile stability over chasing credit card rewards. We will walk through how a single new credit application can trigger a hard inquiry, force underwriters to re-verify your credit, and possibly delay or even cancel your approval. We will also quantify how foreign transaction fees typically pale in comparison to the risk of derailing a mortgage closing. Finally, we will provide a practical, step-by-step freeze playbook and conclude with a quick quiz and key takeaways. First, let's set the stage. When you apply for a mortgage or any major financing, underwriters care about predictability. Any change, like a new credit card application or a new account, can require them to recheck your credit report and debt-to-income ratio. That re-verification can result in delays, higher rates, or, in the worst case, a denial. Therefore, the best strategy is to avoid any new credit activity until your loan is closed and funded. Next, here is our agenda. We will cover the golden rule of credit stability, how underwriting reacts to inquiries, why foreign transaction fee savings are usually negligible relative to mortgage risk, a practical freeze playbook, what is safe versus risky, a closing timeline, a short quiz, and then the key takeaways. Now, the golden rule is simple. Stop all new credit activity. An application triggers a hard inquiry, which almost always forces re-verification by underwriting. This is where a slight drop in your credit score or a subtle shift in your debt-to-income can tip the scales, causing delays or even a denial. Short-term credit card perks are easily outweighed by the long-term priority of securing your financing. Then, once the loan is signed and funded, you can start pursuing rewards again with far less risk. Before we go further, a quick disclaimer. This content is educational and not individualized financial, legal, or tax advice. Policies vary by lender and by loan type. Always consult your lender, follow their documentation requirements, and confirm whether any action, including a credit freeze or temporary thaw, is acceptable under your specific underwriting timeline. Let me explain the flow. While in the mortgage process, if you open new credit, a hard inquiry is generated, prompting underwriters to re-verify your file. If this recheck shows that your score fell or your debt-to-income ratio changed materially, the approval can be delayed or denied. If there is no new application, your file remains stable and proceeds toward closing. Even smaller moves like adding an authorized user or requesting a credit limit increase can prompt questions or additional documentation. Let's quantify the foreign transaction fee discussion. A common foreign transaction fee is around 3%. If you spend $2,000 abroad, that is roughly $60 in fees. By contrast, the potential cost of a delayed or denied mortgage, whether in the form of a higher rate, a lost purchase contract, or extension fees, can easily reach hundreds or thousands of dollars. Therefore, the math strongly favors avoiding new credit card applications for zero FTF during underwriting and instead using temporary alternatives like debit or planned currency withdrawals. Here are a few scenarios. With foreign transaction fees at about 3%, $500 in spending leads to $15 in fees, $2,000 to $60, $5,000 to $150, and $10,000 to $300. Even at higher trip budgets, these fees tend to be small relative to the risk of causing underwriting delays or jeopardizing loan approval. Let's compare the two paths. On the left, chasing sign-up bonuses or a zero foreign transaction fee card right now involves new accounts and hard inquiries, which can alter your debt-to-income ratio and create additional documentation requests. On the right, prioritizing mortgage stability means you avoid any new applications until the loan funds, keeping your score and DTI consistent and allowing a smoother underwriting process. After the loan closes, you regain the flexibility to pursue rewards with much less risk. Here is the practical playbook. First, confirm your lender's policy on credit freezes and whether a temporary thaw will be required during underwriting. If permitted, place freezes at the 3 major bureaus and coordinate any thaw windows with your loan officer. Stop all new credit applications, credit limit increases, and adding authorized users. Keep existing cards open, but minimize use to maintain low utilization. And be sure autopay continues to prevent late payments. Avoid buy now, pay later, store cards, and promotional financing. If the underwriter needs a refreshed credit pull, arrange a limited thaw and refreeze immediately afterward. Once your loan closes and funds, you can safely return to your reward strategies. Let's categorize activities. Safe moves include keeping existing accounts open, paying on time, and maintaining low utilization without spending spikes. Using debit or cash temporarily can help avoid new lines. Risky moves include applying for new credit cards, requesting credit limit increases, opening an auto loan, buy now, pay later, and store cards. Also avoid co-signing for someone else and taking on large balances that can shift your debt-to-income ratio. Do not close long-standing accounts abruptly, as that can affect your credit profile and average age of accounts. This timeline shows the key phases. From pre-approval onward, avoid new credit. During underwriting, freeze or pause all new applications and keep utilization low. When conditions are issued, provide documents and avoid any credit profile changes. As you approach clear to close, do not touch credit and keep balances steady. After funding and recording, you can plan to thaw and pursue reward strategies. To reinforce the message, here is a compact summary using Markdown-style bullets. Focus first on mortgage approval and funding. Preserve your credit score and debt-to-income ratio by avoiding hard inquiries. After closing, you can resume reward strategies. The budget snapshot reiterates why the foreign transaction fee usually does not justify risking the mortgage process. The rule of thumb is not to risk the loan for a short-term perk. Quiz time. Which action most commonly forces underwriters to re-verify your credit during a mortgage process? Option A. Paying your current card bill early. Option B. Making a new credit card application. Option C. Using a debit card abroad. Option D. Letting autopay handle existing bills. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is making a new credit card application. That action generates a hard inquiry and potentially a new account, both of which typically trigger underwriter re-verification. For the second question, financially, which is usually smarter during underwriting? Option A is chasing a $60 foreign transaction fee savings by opening a new card. Option B is avoiding new credit activity to protect the mortgage approval. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is avoiding new credit activity to protect the mortgage approval. The risk-adjusted cost of jeopardizing or delaying a mortgage almost always exceeds the modest savings from foreign transaction fees during the underwriting period. Here are the key takeaways. Stop all new credit activity until your loan closes. Hard inquiries will trigger re-verification. Protect your credit score and debt-to-income by keeping balances low. The typical foreign transaction fee savings rarely outweigh the risk to your mortgage. After the loan is funded, resume rewards with a clear plan. To summarize, prioritize getting to the final signature over short-term perks. Coordinate any credit, freeze, or thaw with your lender so they can schedule necessary checks. While traveling during underwriting, lean on debit or cash temporarily. Once the loan funds, you can safely pursue sign-up bonuses and optimize your card strategy. Thanks for watching. If this video helped you protect your mortgage or clarified your credit strategy, please like, share with a friend who is house hunting, and subscribe for more smart money breakdowns. Drop your questions, experiences, or horror stories in the comments. What would you never risk during underwriting and why? See you in the next one.